day after rallying sharply on hopes of a bailout for Greece, the stock market taking a hit on Friday after China raised reserve requirements on its banks yet again, trying to tamp down inflationary pressures there. I'm joined now by Michael Pinto. He is senior market strategist at Delta Global Advisors. Michael, generally speaking, was the action we've seen here the last couple of weeks telling you that the rally from last year's March lows, is it ending, or is it just a temporary setback in a bull rally?
Well, thanks for having me back again, Aaron.
Thanks for being here.
And I think the rally from March of 2009 was presaging this comeback in GDP. We had a 5.7% GDP print last release from the NBER, and I think that was already priced into the market and was presaged again by that move that we saw since March of 2009. Now going forward, we see that China is aggressively trying to burst their property bubble. They are raising rates, raising reserve requirements. Glenn Stevens over in Australia is taking interest rates higher. So the global economy is slowing. That also is being indicated by the sell-off in copper. Copper was at $3.50 a pound, went all the way down below $3. Now it's just flirting with just above that $3 a pound mark. So if the global economy was going to come back in a V-shaped recovery, instead of the TP like I predict, then you'd see oil rallying well above $80. You'd see copper going up back towards $4 a pound. You don't see that, and that's why I think we're having a double-dip recession here in the United States and a slowdown, unlike what the IMF predicts, a slowdown in global GDP.
Very interesting, because last time you were here, the first time you were here in September, it was, you said you should be long stocks as long as the Fed's at zero.
Right.
The Fed's still at zero, and we can talk about whether, if the dollar's weak, does that really, are you making as much money as you think you're making? But is it still right to be long equities? Or because the Fed's only talking about the exit strategy, they're not doing anything yet.
Right before the release of the November non-farm payrolls report, I sold all of my position in precious metals. I since then brought half of them back. What's happening now is, and it's priced into the Fed funds future market, we are waiting for Ben Bernanke to get off the 0 to 25 basis point rate stance that he has. And I think that he will not be able to do that, especially in light of the fact that the U.S. dollar has had this huge move higher, it's actually above 80 on the DXY as we speak today. So imagine Ben Bernanke, who is paranoid about a deflationary depression. That's what he studied. That's what he's worried about. He's very hell-bent against doing anything that would precipitate another double dip in the economy. So the last thing he wants to do is further exacerbate that move in the U.S. dollar. So right now, I'm waiting for Ben Bernanke to acquiesce and to admit that he's stuck at zero, exceptionally low for an extended period of time is what you're going to get. And once that's being realized by the market, and I think that's going to come probably in the summertime, when he returns to QE, quantitative easing, when he again has to purchase 10-year Treasury notes, when he has to continue purchasing MBS, mortgage-backed securities, then you'll see a fall in the value of the dollar, and that's when I'll buy back the other half of my precious metal position that I sold.
So what does that mean for the stock? When you're saying when people start to come to that realization, then the idea that low rates are good for the market comes to an end? Is that what you're suggesting?
No, I think low rates, inflationary low rates, are going to be positive in nominal terms for the major averages. You get real returns. If you want to garner real returns, you have to be invested in precious metals, base metals, energy, and foreign stocks that pay a dividend.
Right. Can you, any specific stocks you can talk about that you
I
like?
like Penn West Energy. I like SQM, the Chilean miner with lithium and fertilizer. I also like, of course, gold here. But I think it's going to be the next big move in the yellow metal when we blow past $1,200 an ounce is going to come in the summer when the investment community realizes and embraces the notion that Ben Bernanke is going to have to sit on his hands. He cannot exacerbate this move higher in the U.S. dollar.
Right. So you're saying this dollar rally is temporary. Cannot be sustained.
Well, the dollar's not really rallying. The
euro is falling.
Euro is falling, and there's a difference. There is a difference. There's no intrinsic change in our interest rates. There's no intrinsic change in how much money the Fed is printing. The monetary base continues to grow. The Fed's balance sheet continues to grow. There's no change in the U.S. dollar as you would measure it against hard assets. There is no intrinsic change there. There is a change in how we measure it against the euro, which people think maybe actually the currency could fall apart. The whole European Union could fall apart. I don't think so. But that's what people are trying to
pricing
in. If you look at CDS spreads,
right,
that's what they're pricing in.
If that were to happen, the dollar would rise dramatically. Certainly, I would think because the euro has been looked at as a possible alternative to the dollar. So we're thinking about the dollar is not going to be the reserve currency of the world.
That's right. That's exactly
Wouldn't
what's
money
happening.
come back into the dollar?
Exactly.
Is that a risk if you own gold and other hard assets?
In theory, it's always dangerous. In theory, the fact that one fiat currency is rising against another fiat currency shouldn't really mean that you're going to lose value. The dollar should not lose value against gold. The dollar should still lose value against gold. It should not gain value against gold just because another fiat currency is having more problems than the dollar is currently. But people say, the euro's rising, the euro's falling, the dollar's rising, so we have to sell gold. That's not really, in theory, what should happen. And in the long term, it's not what's going to happen. People need to own hard assets to hedge against the falling dollar, and the dollar is being depreciated, even though it won't show up, won't manifest itself against the euro.
All right, Mike. Thanks very much.
Thank you.